There's something quaintly British about trying to accentuate the positive from UK markets at the moment, but it's getting increasingly tough, even by our stiff upper lip standards. Exhibit 1 for those trying to stay smiling is the FTSE 100. Just look at it go. It had a wobble the day after the referendum, but it's now up at its highest levels for the year. Among the big winners, shares in British American tobacco are at a record high. Who says stress-induced smoking is a bad thing? But this is a very poor measure of the health of the UK economy. The FTSE 100 is crammed with companies that earn their crust overseas. The unprecedented collapse in sterling is just what their bottom line needs. Analysts are even referring to the FTSE 100 in local currency terms, a description usually reserved for shaky emerging markets. Ouch. The more domestic cousin, the FTSE 250, is a much better gauge, and it's not looking great, even with the support of likely easing from the Bank of England over this summer. As for sterling, well, yes, you can argue that its gutting over the past few days is a boost to British manufacturing, and on the margins it will help. But as a tonic, it's a stretch. The market has never seen a decline like this before. It's not a great advert for putting money to work in the UK. And the drop in the pound after the 2008 crisis hardly delivered that effect on manufacturing. Lastly, gilts are at a record high, and the UK government has demonstrated that it can borrow for the best part of nothing without deterring investor demand. Again, that will almost certainly help on the margins. It's a cushion. But let's not confuse why this is happening. The market is pricing in a full-blown recession. It does no one any favours to panic, and it's worth remembering that markets are still, despite it all, operating smoothly. But it also doesn't help to pretend that the referendum result is passing without a hitch. It's time to get real.